Goldman Sachs recommending a few investment strategies to navigate the uncertainty, saying in a note to focus on services providing rather than goods producing companies. Some services names include Microsoft, Amazon, and Alphabet. Joining us is Aaron Dessen, who is the financial advisor at Payne Capital Management, and Matt McCall. He's the president at Penn Financial. Let's talk about what Goldman has said here in terms of stock picking, hedging against the trade war. And they point to services over goods largely because there's less exposure to foreign input costs subject to tariffs. I mean, it seems like a pretty rational explanation to get into services.
To me, it seems like, Goldman is probably telling their larger clients this a year ago, but now they're giving it out to the public. This is something that if you wanted to do this a year ago to hedge, you can see how well the services have done versus the goods producing. I mean, it makes perfect sense. If it's services, it's here in the country. If it's goods producing, we get to, a lot of times import things from China and there's tariffs on it, so it costs more. So that strategy is fantastic if you truly believe that this trade dispute will go on for another year. You want to be in that sector. I think it ends sooner rather than later, so I want to go the opposite way and look at the goods companies that I believe are bargains at this point.
What do you mean when you say it ends sooner rather than later, in terms of getting an actual deal?
Yeah, there's no way that Trump will not get a deal done before the election. It's just impossible. They're playing a game of chicken. I was just in China a couple months ago. Things are great over there, but they're getting to the point where it's starting to hurt them a little bit now. But it's hurting us more, I believe. And politically, he's going to commit suicide if he doesn't get a deal done soon.
What do you think, Aaron? You agree?
Respectfully, I disagree. I think if you look at the numbers economically, we've seen U.S. exports down less than 1%, which is really just a drop in the bucket. I think that there's a case for some services companies over goods companies, but it's not just a broad stroke. If you look at Amazon, for example, trading at 66 times forward earnings, that's quite a premium. I'd be much more inclined to recommend a stock or retailer like Walmart trading at a third of the valuation.
Yeah, if you want to make this a hedge against the trade war, if you look at a company like Microsoft, sure, it's a services-driven company, but it's got a lot of exposure globally, right? They are one of the few tech companies that have a big presence in a place like China. Is that something that investors should be weighing?
I think, with the trade war, you've seen such a small effect on the numbers for the U.S. Other countries are stepping up in their place. So you're looking at increased imports from places like Europe, places like Vietnam. So I think, where China loses, other companies are stepping up, or other countries, are stepping up. And these are large U.S. companies that we're talking about. They have a lot of resources, and they're able to, shift the supply chain and make those moves to avoid them.
Aaron, it does look like the bond yields kind of nearing their record lows there. That seems to be triggering some of the sell-off that we're seeing there. That to me suggests that the sentiment is not going to turn around anytime soon, right? You look at where the equity markets are, and yet you look at all the safe haven plays, and that seems to point to the jitters continuing to stay. Right.
Honestly, I'm a perma bull, so I'm of the opinion that this is a great time to buy in. Really take advantage of the fear that we're seeing in the market, because we really don't believe that fundamentally the numbers support these fears.